My name's Mike Chamberlain. I've been with Done For You for the last 4 years now. Love helping make sense of what real estate can do to help somebody get into a better place for their financial future and really sleep a little bit better at night or a lot better at night in a lot of cases than what somebody might have been doing without real estate in their lives. And so that's a big part of my role with Done For You is helping people get whatever it is they want to get out of real estate, helping them accomplish that in a faster way, in a smarter way, help them optimize their portfolio. And I come to DFY after spending most of my career, the last 20 years, as a traditional financial planner. So helping people grow their money with stocks and bonds, using 401ks and IRAs, and just amazed at what real estate can do for those who take the initiative and move forward in adding it to their portfolio. So we'll give some perspective on that I hope is helpful. We'll go a little bit fast right now, but if you ever want to slow down and talk a little bit more specifics, please put us to work. That's my role, and I enjoy helping to make sense of this. Of course, in order for somebody to optimize a portfolio and grow it more, they actually have to get in the game. They have to get started. And I so admire when people do that. I think most people recognize the real value of real estate and what it can do for their financial future. The wealthy people either have gained their wealth or maintained it or grown it using real estate the most often. And people recognize that and they want to do it, but very few people actually do it. And so I always am impressed and want to honor and recognize when somebody has done that, with or without our help, really. You get off the bench, you get up to bat, you get on base. That's so important for you to succeed long-term in real estate. So much of it is just getting started and then giving it time and then optimizing opportunities, growing a snowball and making it larger and larger over time, turning one home into two and two into four as you can. They can make these dramatic impacts for your financial future. But it's understandable in today's environment, of course, there's a lot of concerns out there that would keep somebody perhaps from doing it. And the things that I'm hearing most often may be the same things on your mind, whatever stage of real estate investing you're at, looking into it, buying, holding for now, or looking to grow it. We have an environment right now where home prices have skyrocketed over the last couple of years. Pandemic has accelerated the demand for single family homes more than ever before. People want that extra 3-4 bedroom, 2-3 bath out in the suburbs, lower price lifestyle, extra space for that home office. Single family homes is just a sweet spot of rental real estate to be in right now. And it's driven home prices high. And so people wonder, are we in a bubble or home prices going to come down? And then they think about inflation and what that's going to do for their financial future. Every $100,000 that somebody may have had sitting in a bank a year ago, they can now buy about $92,000 worth of stuff today because of inflation. And there's concern about that, understandably so. Of course, interest rates are a lot higher today than they have been for several years. The Federal Reserve's been raising rates. Investment on mortgages, interest rates on mortgages have been going up. And if you're paying more money to the bank, that's less money in your pocket, of course. And so people wonder, does it still work or does it math or crunch out? And so that might keep somebody from investing at this time. And really just overall concerns about uncertainty in the economy. Are we in a recession? Are we heading to one? What will that do to jobs? And will people be able to afford rents? And whatever it is that you hear so much about on the evening news and in the clickbait opportunities out there to spend your time reading about. These are things that are very present and on people's minds today. But let me ask you, as you look at the Time magazine covers, do you see anything out of place, anything different? Maybe the art is a little bit dated, or you may notice that this is Paul Volcker, who happened to be the Federal Reserve Chairman back at the end of the 70s and throughout the mid 80s. In fact, these are Time magazine covers that are all from a time period, 1970 to 1982, that really was quite similar to where we're at today, both from an economic perspective, but also a world political perspective too. So whether it's those big four that we just touched on, or it's concerns about what's happening in Congress and politics, it's concerns about world wars, the communists, oil prices, protests, you name it, medical costs, all these things that were happening from 1970 to 1982 that really could be on the cover of magazines today. And I thought it'd be interesting to go back and look at how real estate behaved in a similar time period is what we're seeing in today's environment here. And so I went to the Federal Reserve. They have 12 regional banks. One of them is in St. Louis that actually produces all kinds of economic data that you can go to and see these same kind of charts yourself. I grabbed a few perspectives, some screenshots from them to reflect what was happening with inflation, mortgage rates, and other things we'll jump into here in a minute. And right here, this line reflects where interest rates are, excuse me, inflation is today. So as of September 9th, when I'm recording this, 2022, we now have inflation at about 8.5%. 8.5% is higher than it's been for most of the last 50 years. But there was time periods during this, what I'll call the Great Inflation, this 1970 to 1982 window, these red arrows here, where inflation was actually higher. If you take the average during this time period, it was very close to where we're at as of now for last year. It was about 7.9% during the 70s, early 80s, compared to the 8.5 that we're at now. So really high inflation, and that can absolutely affect what happens to home prices and other goods when we're in a similar environment today. Of course, mortgage rates, that we mentioned, another concern. Here we're at about 6%, 5.96% as I'm recording this, around the middle of September. And if you look at where that's at, that is higher than it's been, dramatically higher than it's been the last few years, of course, higher actually than it's been for most of the last 15 years, 1.5. But if we look at the bigger picture, it's lower than it's been for most of the last 50 years, 5.0, and certainly lower than it was when interest rates got out of control back when they were trying to tap down inflation end of the 70s, 80s here as well. And so mortgage rates were something to deal with then. Actually, the numbers were harder to work with than with home prices when you paid so much interest to the bank. And yet, during that time period, if we come down here to what happened to home prices in the same window of time that we're looking at inflation and mortgage here, these same red arrows, 1970, 1982, you have home prices that consistently, steadily went up. Home prices that, in fact, went up the most in any of the recorded history of home price appreciation. If you had bought a home, over here some of my chicken scratch Excel notes here, if you'd bought a home in 1970, you would have paid about $24,000 for it on average across the US, a single family home. If you had bought that same home after this inflationary time period, you would have paid 3 times as much. And we certainly are not expecting that kind of appreciation moving forward. We don't want it. We just want home prices to be normal and appreciation to be normal. We don't need what's been happening the last couple of years for real estate to be a very attractive investment vehicle. But if we do look at a similar time period, it actually was a big part of why home prices were going up so much. It costs more to buy lumber, it costs more to pay a laborer to build a home. It's not the builder that's taking that on the chin. Of course, they're passing that on to the buyer. Same as a good quality company that makes goods and services that need to be bought and used in all environments. You know, they're paying more to produce the item. Of course, we're all paying more in the end at the store when we go to buy it. That's what inflation is, how it works. They're just businesses, builders just passing it on to the consumers. And so it's interesting for me to see that inflation, mortgage rates did not stop home prices from growing during a long extended period of time. There have been other periods of time where the economy did have a dramatic pullback, of course, in home prices. So I thought I'd just throw in as a quick bonus here, a side note, what home prices look like in a time period that's very much on people's minds today. 15 years ago, the beginning of 2007, if you had bought a home then around the Great Recession time period, you would have had to hold on to it for 6 years, from the beginning of 07 to the beginning of 13, to get back out of it what you put into it. And so real estate does not always go up. I like to emphasize that. I like to be realistic in an investor's expectations. I would not encourage somebody to buy a single family home or any kind of real estate if the expectation is it always needs to go up. And if it ever goes down, I want to get out of it. Because whenever you have any kind of ownership investment, stock, ownership of companies, ownership of commodities, certainly ownership of real estate, like we help people with single family homes, it's going to go up, down, and sideways in the short run at times. In the long run, real estate has always gone up. Not always a good short-term investment, always a good long-term investment. And so I thought it would be good to point out what a relatively short period of time, 6 years compared to the 52 we're looking at here, you know, when real estate did not work out as well as it normally would. But that's the worst time period in any of our lives. Anybody born since the Great Depression, since the 1930s, the worst time to have purchased a home for it to then go down and take a while to recover was the beginning of 2007, around this Great Recession. And that's a time period where I think it's understandable. That's still in people's minds, what happened to their home prices. And it may give them pause. Are we in another Great Recession type environment? And I just like to quickly contrast, you know, where we were at then. Shortage of homes back then, shortage of homes today compared to a huge excess of homes back then. Totally different lending standards that have made it so you could buy a home back then without money out of pocket. You could buy it really without verified income. Liar loans, they're sometimes referred to, a mere loan. You know, if you're alive and breathing, you could get a loan. And you had all kinds of excess speculation driving up home prices and driving up the number of homes that are available out there. And when it all kind of hit the fan, that pulled back, and you had people that did not have equity in homes, and so they were more likely to walk away from it. Today, you have people that not only is investment property, they had to put 20% or more down to get into it because the regulation and lending has actually changed and for the better in most cases since this great recessionary time period. So not only had people had to put a lot of money into it before they could even purchase an investment property, but home prices have gone up so much that there's now about $180,000 on average in equity in people's homes across the nation. And so if somebody's life situation changes, they're not going to just walk away from it because they don't have equity in it. They're going to sell it. And maybe they take a little bit of a haircut to sell it quickly, but they're going to capture some of that equity that they have in that home or most of it. And that totally changes what happens to home prices if there's not fire sales because of foreclosures or other financial conditions like that. And so very different environment, whether it's the supply and demand of inventory now, whether it's I should point out that back during the Great Recession, we're talking here about home prices going down what looks like about 20% on average across the nation. There were areas in the country that went down much more than 20% back then. That's actually where Done For You developed its current business model, where we saw a huge opportunity for investors in Las Vegas and Phoenix, and we went out and developed the relationships with the local partners, the boots on the ground, the construction teams, the property managers, the license agents that we're now doing in many markets around the country. That's when that business model was created, because there was great opportunity in some markets around the country. And in today's environment, I think it's good to point out it's more important than ever that somebody's paying attention to the markets where they are purchasing investment properties now. It's really been over the last few years where you could kind of throw a dart on the wall and it would work at the dartboard and it would work out for you. But now, and this information, let me quickly point out, it's not my opinion or Done For You's. We're simply reflecting core logic of well-respected analyst firm in the industry. There are areas of the country reflected in the red, dark or lighter red shades here, where they expect home prices to go down. And there are other areas of the country reflected in the blue or lighter blue, where it's not likely that home prices will go down. Again, no guarantees, nobody has a crystal ball. But I like to point out, it's a time period to be cognizant of what you're doing, where you're doing it, and certainly being in an area where you have a population growth that's higher than average, where you have job growth because the economy is strong in that area that's bringing good quality jobs and people moving to that area to take those quality jobs. And not just a good job, but a job that increases pay at a higher rate. We have areas that we help people invest where when somebody gets a raise, instead of it being a $2 raise, like it might be on average across the nation, they're getting a $3 raise and 50% more pay increase in those areas because there's so much need for quality employees. And of course, those are the people that we love to help provide a roof overhead for and have a good quality top of bell curve kind of demand for a quality 2-3 bedroom, 3-4 bedroom, 2-3 bath home in a good neighborhood in these kind of markets around the country. So again, real quick here, the areas that we're helping people invest, these are all the areas where it is, according to CoreLogic, very low or low likelihood of home prices going down in the coming year. So what happens if home prices do go down? The great beauty about real estate, the thing that's unique to real estate to any other investment I ever help somebody do, is not just growth for the future or just income now. It's not just maybe a little bit of both of those, but it's also growth and income, as well as tax savings and more effective leverage, and just so many ways that you can benefit from real estate, where if one thing's going down, you have another thing that can be working well for you and benefit you from being involved. And one of those things, of course, is that rent. So here we have, again, the same 50+ year window of time where home prices did not always go up, they went down. And yet went up overall dramatically over time. It's kind of like somebody walking up a hill with the yo-yo. The yo-yo's going up and down. The overall direction of that person is up. And you kind of see that with the home prices. But it's really interesting and comforting to me for our investors to look at what happened to rental rates during the same window of time. So here during the great inflationary time, 1970 to 82, you have rents that actually doubled. Again, you can see some of the details over here. But in a time period where homes went up, you also had rents that went up dramatically, doubling in that 13-year time. Even in a time period where home prices went down, though, you have rents that didn't go up all the time. They were flat here for a few years on average for single-family homes across the nation, but they stayed flat. They didn't go down. In certain markets they did, but overall you have great consistency with rents going up over time. And here's where it's so important. If we looked at an index here, according to the Federal Reserve in St. Louis, the regional bank there, an index of what a single family home rented for, not actual dollars, but a measurement of the price, it was 45 back in 1970. Today, that same rental index is at 370. And so rents have actually more than 8 times what you pay, more than 8 times today what you would have paid to rent a place in 1970. And what's important there is that 8 times growth or increase in rents is actually more than what inflation has been, even when you include, again, this hyperinflationary time period back here. So you have a dollar back in 1970 that would have bought a certain amount of goods that you today now need $7.41 to buy the same amount of goods because of inflation. A dollar needing $7.41 today to buy what a dollar did before. A dollar's worth of rent in 1970 now being worth $8.12 to you, just barely outpacing inflation. That's huge. That's dramatic. That's so important. You know, to me, a successful retirement is having dignity and independence in a rising cost environment that you can't outlive. And that rising cost environment is what so often can blow up somebody's financial future. You retire and you need a certain dollar amount to pay the bills. Let's call it $5,000 a month. A couple decades into retirement, you now need $10,000 or so if you have normal inflation to buy the same amount of goods. And a lot of people don't plan for that, or they don't have the kind of investments in their portfolio that can outpace that and have something growing for their future. Real estate does, not only with the home prices appreciating behind the scenes, but also with those rents along the way. That's just huge. I've looked at a lot of charts of income producing assets, you know, CDs, bonds, annuities, what most people are doing. None of them are as consistent as what you can see here with rents going up over time. And that's just so important for your overall financial success and future success. It's also something that I think is worth noting in this environment. You know, the positive cash flow that we have built our business on for 15 years, we've helped people buy in markets where homes cost less and rents are higher, so that there's enough money left over for them to pay somebody else, a property manager, to do the work for them, pay a repairman so they're not fixing the toilet in the middle of the night, you know, have a done for you type of experience where you can do what you enjoy, and this can be happening for you very passively on the side. You know, we've helped people do that with a little bit more positive cash flow as a kind of reward or kicker for them along the way than what's available today. When home prices are up and interest rates are up, there's not as much positive cash flow today. But if you're buying a home for income today, you still have a very attractive income compared to what else you might be doing by just paying cash for that home. Or if you're in a growth stage of life, if you don't need the money now, but you're trying to grow a portfolio for your financial future, maybe you have 10 or 20 years before you need it, then I think this rental rate chart is very important for you to think about. It's not so much what the positive income is for you today, is what is it going to be for you when you really need it to replace your paycheck, you know, 10, 20, 30 years from now. And that rental rate is so important to somebody being successful with rental real estate and replacing income over time. So just a quick side note on that as well. What happens with rents next? Can't tell you, no guarantees. What I can tell you is there's just a huge demand for rental properties. That's been the case for the last couple of years. Not just home prices going up, but the rents to rent those homes have been going up. I like using my example, or example rather, of my brother. He's got a good 6-figure income job, a tech job, and he's been working with a company in Seattle. The pandemic hit, and he had a team of 8 people that worked cybersecurity for this company. 4 out of the 8 people moved to other remote areas, 2 hours out of the city onto a farm, down to Texas, out to the Big Island in Hawaii, you know, different areas where they could live where they wanted to, where they could pay more for, less for a 3 or 4 bedroom house than what they're paying for a 1 or 2 bedroom apartment in the city. and just have a more enjoyable lifestyle. That's happening all over, and that's important as you try to think about, could the tenants afford the rents that we're at now and where they may go in the future. There's just a bigger pond of fish out there, so to speak. People that are making more money and able to afford these higher rents that the market is demanding right now. So lots of different reasons, different perspectives. You can come back and slow down on that. Another question on people's mind is what's happening to real estate if we go into a recession, or if we're in a recession now. Again, no guarantees anything can happen. But right here, we're looking at these gray vertical lines. We're looking at 8 of the last 8 recessions that have happened in the U.S. economy. Sometimes recessions have been very short, like when the government shuts businesses and people down during the pandemic onslaught. You have this very skinny, slender, short recessionary time period. Sometimes they're longer, like this Great Recession. But this is the time periods over the last 50 plus years that we've had recessions. And again, looking at what happened to single family home rental real estate prices, I cannot tell you that they're going to go up if we're in a recession. In fact, they've gone down a little bit here for a month or two, a lot here for several months during the Great Recession. But it's interesting for me to see, if we look beyond that, you have home prices that actually stayed very flat or even went up during most of the last 8 recessions. And again, moving forward, anything can happen, but don't buy a single family home if you're looking at what it will do for you in a year's time. If you're looking at what it will do for you in a decade's time, boy, it's always worked out well for investors if they give it time. And even in recessionary times, sometimes it works out well in the short run. So I think that's something that's worth considering in today's environment. Single family rental real estate certainly will perform much better than what else most people are doing with their money. I like to contrast that. And again, I like stocks, I like bonds, I like being diversified. I like having some money just sitting in the bank account doing nothing for you besides buying some peace of mind. Not a lot of it, but enough that you need for expenses over the next year, known expenses that you need money for. Leave it in the bank account. Even though there's inflation, it's going to be there for you. But if it's your long-term money, if it's money you need for your future, here's what it's looked like if you had invested in stocks, or what bond yields would look like compared to single family homes over the last 50 years. And again, be diversified. Not saying put all the eggs in one basket, but what I can tell you, one of my favorite things about real estate is, compared to what else people might do with their money, it just tends to provide more peace of mind and more confidence that it's going to be there for them. Because if somebody's only had experience with other kind of ownership investments like stock, you have the stock market here that lost 24% earlier this year. It lost 34% when the pandemic hit a couple of years ago. It lost 57% in a year and a half's time back during the Great Recession, 49% when the tech bubble burst. You don't even notice this blip back here on Black Monday in October of '87. The stock market lost 23% in one day. And when somebody is on this roller coaster ride, but boy, if you lose 50%, I was sitting across the desk from clients, hundreds of clients that I worked with at this time period back in the 08-09 time period as a traditional financial planner. And when you lose 50%, you wonder if you're going to lose the other 50%. You don't want to lose it all. So the tendency is, let me sell out, at least I'll protect what I have. And so again, compared to what else you might do, you have the single family homes, which again, have not gone up in a straight line, but have been much more consistent than alternatives that you might be looking at for your money. So I guess the general theme that you can be picking up here is there's lots of ways that the real estate benefits you. It doesn't mean that it's easy all the time. Doesn't mean there's not surprises. We try to mitigate the risk. We try to help you buy in the right markets and the right type of homes. But there can still be surprises. But boy, I've done hundreds of reviews with our clients, and every time they've owned a home for 5 years or more, their total return on investment is more than anything I ever helped them do with traditional investments. Usually double, sometimes triple, depending on what's happened with inflation during that time. And that's just one way that people benefit, is that equity going up, that cash flow, the tax savings. Again, my most favorite thing about real estate isn't necessarily the features that I'm mentioning there, leverage and tax savings. It really is the peace of mind that it can afford somebody, that the future is going to work out, that they have a plan in place, and they're going to be there for the long haul. It's totally confident that it works for somebody who gives it time. So lots of ways real estate can benefit people. That's not just our biased opinion here at a real estate investment company, but lots of individuals have commented on that. You have Elon Musk earlier this year saying in this inflationary environment, it's generally better to own physical things like homes or stock in companies that make good products than dollars when inflation is high. You have the Gallup poll that does all kinds of research, talking to individuals, saying, what do you think is the best long-term investment? And for years, single family homes or real estate investing has been viewed as the best long-term investment. I don't think that's any surprises there compared to stocks, bonds, gold, leaving money in the bank, or the alternatives they give somebody to choose from. You have, of course, what sometimes is referred to as smart money, institutional money, hedge fund money, whatever you want to categorize that as. Pensions here is this article in the Wall Street Journal talking about institutional money going to real estate. And because there's fewer places that they can put money to work and provide the inflation protection that their investors, that people need. It used to be that you had a lot of places you could kind of hide your money from the inflation monster, if you will. And those hiding places have been disappearing, but real estate still works. And so you have a lot of this smart money coming towards real estate. And it's not just institutions like that, but of course, Warren Buffett, considered the greatest stock investor ever, chairman of Berkshire Hathaway, loved his insights on investing in general and his prowess with this. But particularly really love his comments about real estate investing some years ago. He was being interviewed on CNBC, and he said, if I had a way of buying a couple 100,000 single family homes and had a way of managing them, I would load up on them. And then he went on to say, I think that's probably as an attractive an investment as you can make. And so Warren Buffett talked about how he'd buy several 100,000 single family homes if he had a simple way to manage it. Obviously, that's what we do. We haven't helped anybody buy several 100,000 homes yet, but we have helped people get off the bench, get up to bat, get on base with one home to see if it worked. And then when they find out it does work, buy a second home and a third. So many of our clients that we've helped over the last 15 years add more certainty to their financial future, have more peace of mind now. Lots of success. I love hearing from clients the impact it's made in their lives. And so that's what we focus on. We do it by helping them buy it where the numbers make sense. We're not making stuff up. We're just crunching numbers and doing some research behind where is a good area for somebody to invest, what type of home, what type of market, giving people numbers to consider so they have some more confidence, and that often helps them, that hand holding, get off the bench and get up to bat. Because the name of the game really is getting on base, and then just giving it time. Here in this lower cash flow environment that we're in, the income is not as attractive as I mentioned before, as it's been for most of our 15-year history. But I'll tell you that if you interview and talk to successful real estate investors that have been doing this for several years, none of them are going to say that they got rich off of real estate because they got a low interest rate that led to more cash flow along the way. That's an important part of an investor's experience. Getting more cash flow now helps you feel better about it, helps it pay for itself. It's something that we recognize the value of that, and we try to help people do. Again, we try to help you buy homes for half the price you might in your backyard, the rent for hire, so that you can have more cash flow and it can pay for itself. It's important, but it's actually a small part of the total benefit that real estate is doing for you, that initial cash flow. It's a part that you may not even remember what the initial cash flow was 10 years later. 10 years later, when you've had a home that's grown in equity and value, that you can cash out some of that equity if you have a loan and put it to work and buy another home. So you've turned one home into two and two into four, 10 years later, if you get kind of normal experience with this. Money that you keep, whatever, even though the cash flow is lower today, you're keeping that because of the tax savings with real estate. And maybe even most important, having a system and a team in place that helps you stay focused on that long-term goal, so you're there for the long-term benefits. That's what real estate, what we do to help rental real estate investors, have a system in place and a team that helps you stay invested, so you're more likely to get off base, get in the game, and be there for the long-term success. That's what I enjoy helping our clients stay focused on, is what the home's doing for them, perhaps behind the scenes, areas that maybe they have not been front of mind because of all this other distraction that's out there in the economy, in the financial conditions that we're in today. But just being focused on what real estate can do for them long term, I think is so helpful. And so we do that for our clients. And again, all to the extent of the goal of helping them be there for whatever they're investing in real estate for their financial future. I like referencing my mother-in-law. My wife was born in 1973. She had just bought a home the year before she had her only child, my wife, for $50,000 in 1972, excuse me. This home they lived in for the first few years, and then they kept when they moved to be closer to or to be closer to my mother-in-law's work, and they turned this one single-family home into an investment property, a rental. And 30 years after she purchased it, she sold it, not for the $50,000 that she paid for it, but for $450,000. And that's something that took time. She didn't have that kind of dramatic impact in her financial future overnight. But 30 years later, most of that time period, she had tenants in there that paid off the mortgage for her. She had this growth that she was able to take advantage of. That's made a huge impact in her life. And just kind of as a side note, that same home today, had she kept it, is worth about $1.4 million. And these are dramatic numbers. I'm certainly not telling you to put money into real estate and expect it to double overnight. I'll tell you, if you get average returns, it doubles every 20 years. That's what real estate appreciation is averaged over time. With this particular home, this is not off the charts, got lucky because of where she invested. This is about a 6 or 7% return, depending on the different windows you might look at, that this home's appreciated over time. That would dramatically change somebody's life with just the one property. But then if you can have 2 and then 4 and then 8 over time, what a difference that makes for your financial future. And by the way, this example is just showing you what the cost of the home was had you paid for cash out of pocket, that $50,000 you would have paid. If because of the power of leverage and real estate, she could have actually purchased this home for about $15,000, or investor could have at the time $15,000 out of pocket, and had that $15,000 grow to these numbers that we look at with the mortgage being paid off by somebody else later on. So important, especially in this environment, that somebody is asking themselves, what they're investing for. And if they're investing for income today, there's still very attractive opportunities if you pay for a home with cash. If you're investing for a home for your income in the future, just keep that in mind. This is future money. And successful financial planning 101 is you have different buckets of money sitting in the bank, money that you're going to use in the next several years, but then money that you're going to use a decade or two from now. Boy, you've got to do something to help it outpace inflation. You got to plant a field that you're not focusing on harvesting today. You've got a different crop that you're going to when you need to put food on your table, but you have something going on to help you with your financial future. And in this environment, it is a very attractive time to be doing that, with rents increasing over time, with homes appreciating behind the scenes, even though they may go up and down in short periods of time in between along the way. Over time, it's just worked dramatically well for investors to be involved in real estate. So if we can do anything to help make sense of this, to slow down and flesh this out a little bit, please put us to work. Several members of the team would love to have those kind of conversations with you. I really enjoy helping make sense of this so that somebody can hopefully worry less and enjoy life a little bit more now and in the future. Appreciate you listening, and hope to talk soon. Thanks.